Hello, my name is Russell Myers. Welcome to Issues Unite. So, as of yesterday, May 1st, 2023, we saw another major bank failure in the United States. The seizure of First Republic Bank by the Federal Deposit Insurance Corporation, FDIC. Uh, so, let me start off with a little bit of background here. So, regulators seized Troubled First Republic Bank early on Monday, making it the second largest bank failure in U.S. history, which replaces Silicon Valley Bank as the second largest. So, we have seen two out of the three largest bank failures occur in the United States history in less than a 2-month period. So, in addition, J.P. Morgan has assumed the deposits of First Republic Bank, and that so they point out insured and uninsured. The only thing that means is that they took over the deposits of deposits more than $250,000 in the accounts. So no insurance is necessary. If you've got $250,000 or more in the bank, you barely need insurance unless you make some really bad decisions. Anyway, so First Republic's 84 branches open on Monday as branches of J.P. Morgan Chase, which acquired the bank's $92 billion in deposits and $203 billion in loans and other securities. The bank's shareholders are likely to be wiped out as part of the deal. But most of their shareholders, at least half of their shareholders, had already sold out their positions anyway. Before this year, First Republic was the envy of the banking industry. Its well-appointed branches served warm cookies to its clients who were almost exclusively the rich and powerful. Its bankers lured in wealthy clients with low-cost mortgages and attractive savings rates in order to sell them on higher profit businesses like wealth management and brokerage accounts. In return, the wealthy rarely defaulted on their loans and parked substantial sums of money in the bank that could be lent elsewhere. Low interest mortgages, such as interest only mortgages on multi-million-dollar properties, so that they didn't have to pay any capital on those mortgages. I'll get to more information in a moment. Last Monday, First Republic reported its first quarter results and stunned analysts and investors when it revealed that $100 billion in deposits had flowed out of the bank, most in mid-March, immediately after the failure of Silicon Valley Bank and Signature Bank. Its executives took no questions from analysts on an earnings conference call. First Republic's stock plunged more than 50% the day after the report. There could also now be questions about the size of J.P. Morgan Chase, which has more than $3 trillion in assets and is by far the biggest of the too-big-to-fail institutions around the world. J.P. Morgan is so big that by law it would not be allowed to buy First Republic because no one bank can have more than a 10% market share of deposits in the U.S. It is only because First Republic failed that J.P. Morgan was able to step in. So that means that J.P. Morgan now has more than 10% of the deposits in banks in the United States at this time. FDIC expects First Republic's failure to cost the insurance fund roughly $13 billion, which is funded by bank assessments, not by taxpayers. That still means that you're paying for it. How are they going to pay for it? By charging you more money. Now, in 2008, J.P. Morgan also took over Bear Stearns and Washington Mutual. Washington Mutual was the previous largest bank failure in United States history. Now, one of the things to note about this is that, taxpayers are not going to be on the hook for what J.P. Morgan seized in the middle of the night. This all happened in the middle of the night on Sunday. The depositors in First Republic just woke up on Monday morning to find out that their accounts in First Federal no longer existed. They had been moved over to J.P. Morgan with no consent on their part necessary. So, while J.P. Morgan took over the deposits and loans, which are, profit-generating mechanisms, the loss part of it, such as failing mortgages and so forth and so on, were taken over by the FDIC. So yes, you are paying for the loss while J.P. Morgan gets to take over the deposits and the profits. Got it? So last month, in April, several of the largest banks had bailed out First Republic Bank with $30 billion in deposits, but that money was all eaten up by withdrawals, a slow motion run on the bank, basically. So these are three of the largest banks in the United States that have failed in less than a 2-month period. Something you should note of this is that J.P. Morgan was instrumental in the formation of the Federal Reserve. Keep in mind that the Federal Reserve is not a government agency. It is a consortium of private, for-profit capitalist banks. You cannot own, I've done videos on this, you cannot own stock in the Federal Reserve. But private banks can own stock in the Federal Reserve. So, got that? In addition, the FDIC has promised to ensure any loan failures that come from First Republic Bank that J.P. Morgan has taken over for the next 5 to 7 years. So 3 years, 4 years from now, if somebody has a loan, a wealthy person has a multi-billion-dollar loan that came from First Republic Bank, and they default on that loan, you get to pay for it. You getting this? In addition, the FDIC gave J.P. Morgan $50 billion in financing to complete this transaction. $50 billion in financing. Think about that. Now, something else to keep in mind is that of these three banks, these are the three largest failures in U.S. history. They are not none of them have been the largest banks. The largest banks in America that have been assuming the deposits that have been taken in by these failures are in order: J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, U.S. Bank Corp., Charles Schwab, PNC Financial Services, and Truist Financial. Those are the top 10 largest banks in the United States. So why is this a problem? The more and more that the larger banks get larger and any smaller banks cease to exist, the more power that these banks have. As the economy continues to crumble and the government is more interested in the health of the banking system than in the health of the economy, this poses major problems because the banks will get bailed out no matter what. You may not call this a bank bailout, but when the FDIC has taken over the debts of First Federal and all three, Silicon Valley and so forth and so on, as they keep on taking over the assets, but the government takes on the debt, that means that the taxpayer is taking on the debt. Now, I know that the MMT people are going to claim that we can just keep printing money to pay off these debts, but they can never explain why, as we keep on printing money, the value of the dollar is declining against other currencies, which will at some point very likely lead to hyperinflation. Of course, Biden, Janet Yellen, Jerome Powell, Jamie Dimon, etc., the corporate media are all stating that none of this means that the banking system is unstable, and yet over $1 trillion has been withdrawn from the banking system in the past 1 year. Well, little over a year, 14 months or so since the Federal Reserve started increasing interest rates. The Federal Reserve is expected to incur at least one more interest rate increase this year, at least one. Money that may not officially be withdrawn from the banking system, but effectively is. Huge sums of money are being put into money market accounts, which is effectively removed from the control of the banking system. If it is in a money market account, it cannot be loaned out. It cannot be used to pay debts that a bank has, etc. So it is effectively removed from the banking system, even if, such as if you have a money market account with your bank, they're only managing that. They cannot take the money out. They cannot take money out for any reason except to give it to you if you want to withdraw it. That is the only situation where they can remove money from that account for any purpose. Now, this is all happening as we are seeing credit tightening banks while money is being withdrawn from the banking system, banks are loaning out less money because they don't have the liquidity for loaning money out and to pay out withdrawals, which means that smaller banks, local and regional banks, will not have the liquidity to deal with the increasing withdrawals from those banks. So we will continue to see more and more bank failures. Many people are taking their money out of the smaller banks and putting it into larger banks, which they view rightly, and a self-fulfilling prophecy, as being more stable than the smaller banks. Of course, the more that the more that people withdraw from those banks, the more likely it is that those banks are going to fail. So, where is this going? We've got less credit. We've got money being withdrawn from the banking system, more and more bank failures, which results in more and more layoffs. This is just a downward spiral. So, share this video, talk about these subjects. If you can afford it, please donate whatever you can to help expand this channel and my presidential campaign, and I will catch you in the next one. Thank you for watching. Hope you have a good day.